Today we're diving into one of the most important skills any investor can have, and that is the art and science of figuring out what a stock is really worth. We're going to get right to the heart of it.
Welcome. Our whole goal here is to help you cut through all the noise, all the hype, and focus on one thing: figuring out what a business is actually worth, so you can make smarter, more informed decisions.
And it all starts with this one question. This is probably the single most important question we're going to tackle today. Think about it. You could find the most amazing, innovative, dominant company on the planet, but if you pay too much for its stock, it can still be a terrible investment. The price you pay, well, it changes everything.
So here's how we're going to break it all down. First, we'll hammer home why price is so critical. Then we'll get into the mindset. Are you an investor or a speculator? After that, we'll decode where your returns actually come from. And then we get to the fun part, the practical toolkit of valuation multiples. We'll even look beyond the basics and wrap it all up with a checklist you can actually use. Okay, let's jump right in with that foundational idea. It is so easy to fall in love with a great company, a great story, a great product. But as investors, we have to be disciplined. We have to focus on the price tag.
This quote really says it all, doesn't it? You can just think back to the tech bubble in the late 90s. This idea was completely thrown out the window. People believed that as long as the company was cool, someone else, a so-called greater fool, would always come along and pay more for the stock. And you know what? For a little while, that actually worked. Until, of course, it didn't. When the music stopped, anyone holding those ridiculously overpriced stocks was just left with devastating losses.
And that whole story really brings us to a crucial point. There are two very different games being played in the market, and you have to know which one you're playing. So are you an investor or are you a speculator?
The difference is night and day. On one side, you have the investor. They do the hard work, they analyze a business to figure out what it's truly worth, its intrinsic value, and they only buy when the price is safely below that number. Their success is tied to how well the actual business performs. Now, on the other side, you have the speculator. They don't really care about the business's value. They only care about price momentum. They're just betting that someone else will be foolish enough to pay an even higher price down the road.
So if we want to be investors, we have to understand what's actually driving our returns over the long haul. And the founder of Vanguard, the legendary John Bogle, gave us this just brilliant way to think about it. He broke it all down into just two simple parts. The first part is your investment return. This is the real, tangible stuff generated by the business itself. So the dividends it pays out to you and the growth in its profits. The second part is the speculative return. Now, this has nothing to do with the business. It's all about perception. It's just the change in how much other people in the market are willing to pay for each dollar of the company's earnings. And this is where it gets really interesting. When you look at the data over a long period, like the entire 20th century, the results are just crystal clear. Bogle found that almost all of the stock market's return came from that investment return. The real stuff, dividends and earnings growth. Together, that was 9.8%. And the speculative return, all that noise from changing market moods, a measly 0.6%. The takeaway here is huge. Over time, what really creates wealth is the performance of the business, not the whims of the market.
But, and this is a big but, look what happens over shorter periods. Take the massive bull market from 1980 to 2000. The picture flips completely on its head. The speculative return was a huge driver, adding 7% per year. This is where the danger creeps in. When you buy into a market that's being pushed up by PE multiples expanding, you are relying on pure speculation for a massive chunk of your returns. And that's a risky game to play.
Let's make this really concrete. This example shows exactly how paying too much can just wreck your returns, even if you pick a fantastic company. So follow me here. You buy a stock for $30. It's earning $1.50 a share, so you paid a PE of 20. Now, the business does great. Over 5 years, its earnings grow by a solid amount. That's your investment return. But at the same time, the market just gets pessimistic. The PE ratio it's willing to pay for those earnings drops from 20 down to 15. And the result? Your stock is now worth basically what you paid for it. That negative speculative return completely wiped out the solid performance from the business. After 5 years, you've made next to nothing.
Okay, so we've established why paying the right price is so incredibly important. Now for the how. How do we figure this out? Well, let's get practical and open up the investor's toolkit. We're going to look at the common ratios or multiples that help us gauge a stock's price. And first up, we've got the most basic one of all, the price-to-sales ratio. It's super simple. It just tells you how much you're paying for every single dollar of a company's sales.
So when would you use this? Well, it's really handy for companies where the earnings are just all over the place. Maybe they're a young company that's not profitable yet, or they're in a cyclical industry that has big booms and busts. Sales are just a much more stable number to look at. But, and this is a really, really big but, it tells you absolutely nothing about profitability. Think about it. $1 of sales at a low-margin grocery store is not worth nearly as much as $1 of sales at a high-margin software company. So here's the golden rule. Never ever compare PS ratios across different industries. It just doesn't work.
And look, here's a perfect real-world example of this in action. Just look at Motorola back in the day. The PE ratio is completely useless. It's either not applicable because they lost money, or it's just bouncing around like crazy. You can't get any sense of value from that. But now look at the price-to-sales ratio below it. See how much more stable that is? It gives you a consistent baseline to judge whether the stock is getting cheaper or more expensive compared to its own history.
All right, next tool in the box is the price-to-book ratio. This one was a huge favorite of the original value investor, Benjamin Graham. It just compares the stock's market price to the company's book value, which is basically the net value of all its assets on the balance sheet. So this ratio works best for businesses with a lot of physical stuff, right? Think banks with their loan books or big industrial companies with factories and machinery. It's way less useful for a modern tech company whose most valuable assets are things you can't touch, like their brand or their patents. And a key thing to remember here is that a company that is more profitable with its assets, what we call a high return on equity, absolutely deserves to trade at a higher price-to-book ratio. And a quick pro tip. Watch out for goodwill on the balance sheet. It can be a huge red flag that a company just massively overpaid for another company.
And now we get to the king of all ratios, the big one, the price-to-earnings or PE ratio. This is the one you hear about all the time, and for good reason. It simply tells you how many dollars you have to pay for $1 of a company's profits.
So how do we actually use it? Well, there are two main ways. You can compare a company's current PE to its own historical average, or you can compare it to its direct competitors in the same industry. But you have to remember, a low PE does not automatically mean a stock is a bargain. A company that's growing way faster or is a lot less risky probably deserves to have a higher PE. And please be super careful about what earnings you're looking at. A trailing PE uses real earnings from the past 12 months. A forward PE uses analysts' guesses about future earnings, and let me tell you, those guesses are almost always too optimistic.
Look, these basic multiples are a fantastic starting point, but they don't always give you the full picture. So let's look at a couple of more advanced tools that can add a little more nuance to our valuation work.
The PEG ratio got super popular because it tries to fix a big problem with the PE ratio by factoring in growth. The simple rule of thumb is that a PEG of 1 is about fair value. And you can see the appeal, right? But there is a huge danger lurking here, and makes a dangerous assumption that all growth is created equal. It doesn't ask how risky that growth is or how much money the company has to reinvest to get it. And if you ignore those things, you can end up paying way too much for really low-quality, risky growth.
Now, this is a really powerful technique that I think is totally underused. You can just flip these ratios upside down to turn them into yields. The earnings yield is just the inverse of the PE. But even better, in my opinion, is cash return. This looks at a company's real, free cash flow and compares it to the total value of the company. And the massive benefit here is that you can directly compare these yields to other kinds of investments, like the yield you'd get on a government bond.
And check out this real-world example. Back in 2003, you could get a totally risk-free 4.5% yield on a 10-year Treasury bond. At that exact same time, a super stable company like Clorox was generating a cash return of 5.9%. So you could get a higher yield from Clorox, and on top of that, it was very likely that its cash flow, and therefore your yield, was going to grow over time. The bond payment is fixed. That comparison immediately makes Clorox look like a really interesting value opportunity.
Wow, okay, we have covered a ton of ground. So let's bring it all home. How do we put this all together and actually use it? Let's wrap up with this simple, actionable checklist. Okay, first things first, be picky. The goal is to find great companies at good prices. Second, never ever rely on just one number. Use a whole toolkit. Know when to use PS for cyclical stocks and PB for financials. Always dig into the E in the PE ratio to make sure it's real and sustainable. Use that PEG ratio with extreme caution. And finally, always compare a stock's potential return, its yield, to what you can get from a safe alternative like a bond. You know, we started this whole thing by asking about the difference between a great company and a great investment. And by now, I hope the answer is obvious. It's all about the price you pay. You now have the fundamental tools and, just as importantly, the right mindset to start figuring out that price for yourself. So the only question left is, are you ready to put them to work?